Chase money blindly and it will punish you later. Raise capital with clarity and it becomes leverage instead of stress. If you're a founder or operator who knows capital matters, but you're unsure how much to raise, when to raise it, or what type won't quietly wreck your business, this video is for you. Today, I'm going to show you on screen how smart founders think about raising capital and what most people get wrong, and the exact tools we use to make capital decisions without guessing. And fair warning, by the end of this, you may realize you don't actually need as much money as you think, or you need to raise it very differently than you had originally planned. Let me frame the real situation you're in. You're building something real. Revenue may already be inconsistent in your business, or growing, or already solid, but capital feels tight, risky, or confusing. Externally, you're asking questions like, should I raise capital now or wait? Use debt, equity, or crowdfunding? How much is too much dilution? Will this actually help my business grow or just delay a problem? Internally, there's another pressure. You're thinking to yourself, I don't want to screw this up because capital decisions don't just affect cash, they shape control, stress, optionality, and even your exit years from now. One way of thinking about this is founders shouldn't be forced to gamble their future just to fund growth. Capital should serve the business, not own it. If we haven't met, my name is Daniel. I run a strategic fractional CFO and business advisory firm. I work with startups and growth stage businesses that want clarity before they raise capital, not after the damage is done. I've seen capital save businesses, and I've seen it quite literally trap them and absolutely obliterate them. This video is about making sure you end up in the first category. Here's the first truth that surprises most founders. Most capital raises fail before money is ever involved. Why? Because founders raise money to solve symptoms and not systems, aka the root reason. They say things like, we need capital to grow, we're undercapitalized, or if we just had more cash runway, we would fill in the blank. But when we slow down and model the business, we often discover something uncomfortable. The issue, more often than not, isn't capital, it's things like cash flow timing, poor unit economics, decision sequencing, or even just a plain set of bad decisions, or whether out of ignorance, meaning a lack of knowledge, or from a place of greed. And don't get me wrong, some founders want to raise capital to quite literally jumpstart a startup, and I'm all for this, if and when it makes sense. Raising money without understanding all this is like pouring water into a bucket with a crack and calling it strategy. The water, aka cash, will quite literally leak out until there's nothing left. How much capital does the business actually require to reach the next clear milestone? This is where a lot of founders guess and where we refuse to guess. Let's take a look at my app, the Cash Flow Optimizer. Okay, on my screen, you're looking at a simplified cash planning tool. In the toolbox, if we go down to financial tools, we're going to look at startup, budget, and forecast. When we fill this out, it makes it really simple and easy to generate a very basic budget and forecast. Even if you're an established company, this is helpful. Let's say you're a moving company, and actually I want to rename this to Brothers Moving and Fun or something. I don't know. Moving company, and you're a service-based business. Say you've been in business for a couple years and you have 15 people on staff. And we want to look at 2 years out. Well, the tool makes it really simple and easy. Let's say your gut tells you, I think we need to raise $50,000 of capital in some form, whatever it is. Maybe it's a line of credit. We want to bring on an investor partner, you name it. The point is, we guess our gut feeling is we need $50,000 because of clarity in the business at this point, and we just want to do this and pretending to be the business owner in this situation. And let's say that we've been growing really well and we think that we can conservatively grow our business or a good number, let's say just an even 5% each quarter the next 2 years, right? So we have 4 quarters in a year. So we're doing 2 years out, it's 8 quarters. And the first month, meaning month one of the next 2 years, we think we're going to do, let's say, $25,000 in revenue. I'm just picking random numbers. And let's say that our cost of goods sold, which for a moving company is mostly labor costs, is about, I don't know, let's throw 50% just to keep the math simple. So 12,500 per month, $25,000 in revenue, 1,500 in cost of goods sold, or labor costs in this case. Let's just assume that just for example's sake. Say like right now we need to purchase some new office equipment. We need some furniture. We need some legal services, and we know we're gonna. Well, we'll get to the truck in a second. So we're just gonna put some basic expenses in here, and we also know that monthly we have rent. Say it's 1,500, $300 for utilities per month. That's fine. Salaries and payrolls for yourself. Let's say it's you and you have a partner, your COO is your best friend. You started the company together, and you're right now you're each drawing $5,000 a month. Good. Marketing and advertising. Let's say we bump that up to $1,500 a month. That's really low, but let's say that's what we're using. $500 on insurance per month. Let's bump this up to $500 of software subscriptions. We got $100 per month in office supplies. Let's bump that up to two. And professional services. Let's put that at 500 as well. All right. So, and let's say 12 months from now, we know we're going to need to buy another truck. So let's make that be a big one. Let's put that at 25,000, and we need some harnesses or heavy lifting equipment. So let's say that's just general machinery, $5,000. Cool. So the tool is saying that our planned was 50,000. The recommended startup capital, 50,000. So in this scenario, it worked out great. Your capital is sufficient. The lowest balance will be in month 12. So what this does, it shows us by month, again, we're saying we're going to making $25,000 per month, and our cost of goods sold starting at 50% of that. This is showing your operating expenses that we entered in, some invested capital, uh, and your profit by month. This is assuming that this month you got $50,000. Let's say it was a line of credit in this case. So you have $50,000 in the bank. You had a net loss of $6,800 because of your expenses relative to your gross margin and net profit in this case. And then you see the cash balance decreases until month 5 or 6, month 6 here. The cash balance is here. And this is planning for those big expenses, buying that piece of equipment, buying that truck. And you can see how the cash balance fluctuates. And then once we get to here, month 14, so 1 year and 2 months from now, that's when your cash balance starts really going up, right? And this is not a factoring in the payback on that capital. This is just factoring in that balance. Let's say it was a revolving line of credit. And so obviously this would fluctuate. But this is just one way to look at it from a very simple, straightforward example. In this scenario, you always had cash, so you're good. But let's go back for a second. Let's edit this and start it. Let's say that, you're brand new, or you've been making money. But let's say you're only making $10,000 a month, and you're let's still use the 5,000, the 50%. Uh, let's see, $10,000 a month, and let's actually bump this up. Let's say your cost of goods sold right now is 70%, or $7,000 a month in this example. And we have, again, those one-time fees and we have ongoing monthly expenses. Okay, this is going to change the math drastically. You're still going to buy that $5,000 piece of equipment, still going to plan on buying that used truck in this case, because that's a cheap truck, 25,000. Now in this scenario, if you only start out making $10,000 a month and you had planned only raising 50, well, this is saying that your recommended startup capital was actually over $240,000. You need over $190,000 additional capital in order to meet the needs. You see, month 1, your cash balance is over 33,000, and by month 4, you're already negative. So you would already be needing capital Again, this is assuming you started out making $10,000 a quarter and you only grew your revenue at 5%. So this tool makes it really quick and easy to understand the capital um, that you're going to need. And you can, of course, play around with the scenarios, adjust them, and it will make it really easy. And I'm going to come back to the raising capital tool here in a moment. So we have to force ourselves to a place of clarity. Step one is we map the cash inflows and outflows by timing, not just accounting categories. Step two, we define what milestone the capital is meant to achieve for the business. Is it break even? Is it a new hire that unlocks additional capacity? Is it market expansion? Is it de risking volatility and unpredictability in your business? Capital without a defined job is just expensive money. Here's the moment most founders often have in dang realization. They see that raising $500,000 of capital when they really only needed 200,000 cost them control, dilution, or debt service, and therefore added more risk. All capital is not created equal. Debt, equity, revenue-based financing, lines of credit, you name it, each one rewards different behaviors and punishes others. Here's the mistake. Founders choose capital based on availability and not alignment. But capital always comes with rules and consequences, whether they're written down or not. Let's walk through a few quick comparisons. Equity, for example, demands growth and an eventual exit. Debt demands consistency and cash discipline. Revenue based financing demands predictable margins that can support the revenue based financing. If your business model conflicts with the capital's expectations, stress inevitably explodes and is in the not too distant future, even if the money feels good right now. And here's the part almost no one talks about. The best capital decisions do one thing above all else: they increase optionality. That means more choices, more control, and more leverage. Bad capital traps you, good capital gives you room to breathe. That's why we don't start with, how do I raise money? We start with, what future do you want this business to have? And what capital will support that future without hijacking it? All right, let me give you something practical. Below this video, I've linked one of the same capital planning tools we use with clients, a capital raising calculator. On my screen now, you see a capital raising calculator tool that you're going to find also in the description below. This is my free gift to you, and use it to pressure test your assumptions in your business. If you want to raise capital via crowdfunding, WeFunder is a good platform. They have different ways of raising capital on their platform. Highly encourage you to check it out. And so this is the WeFunder. If you want to use line of credit with some more creative financing mixed in, this has three different examples, three different types of scenarios that you might use to pay back that line of credit. And the most interesting one, I think, is the equity split model. There's an equity split model explanation in the form of a PDF that explains how to use the equity split model. And if you are considering actually going the Regulation D, 404, 406B, or 406C route, there's a PDF guide that I've created as well that explains that type of raising capital. If you're thinking about raising capital from accredited or non-accredited investors, that's really important to understand. So be sure to check out that guide. Get this out of the way. Let's see. The equity split model is really a fascinating model. Let's say it's you and a few of your friends starting up this business, or business colleagues that you've known from over the years, and you want to give each person a slice of the pie, a portion of the equity that is a fair based model, meaning some people are going to contribute their time, their talent, their skills. Some are going to contribute cash. Some people might actually contribute already existing equipment or land or real estate to the business. And this allows you to track how much value each person has contributed to the business over a period of time. And then we'll calculate how much equity that person should actually receive in the business. So let's say person one, call him Jack, say he was starting today, and this person is the CEO, right? and their market salary for this company is $250,000 a year. You can go through this and fill it out. It will automatically calculate all the math. So they're going to work a 40-hour work week, and it's pretty cool. I'm not going to go into depth. I could spend a whole video explaining how this all works. Again, check out the PDF guide on equity split model explained, and it'll make more sense. But anything in yellow are the fields that you could change. Anything not in this cream yellow color, you want to leave alone. Otherwise, the tool will break. And what you do is you just open this in Google Sheets, click on File, make a copy, and then you'll have your own version that you can edit and play around with. Right now, it's view only. So if you could look at this tool, you're not going to be able to edit it. But again, just make a copy and then you can edit it on your own. And again, it has lines of credit, crowdfunding, and this equity split, fair equity split model built in. So this is my gift to you in the link below. So at the end of the day, capital is a tool and your business deserves to know how to use it best. If you want help pressure testing a capital decision before it becomes permanent, you can find us in the link below. No pressure, just clarity before commitment. I'll see you in the next one.